Welcome back to Pass the Balance Sheet. There's a moment in business that feels especially disorienting. When the numbers say you're profitable, but your body feels anything but calm. The P&L shows a profit, revenue is steady, maybe even growing, and yet there's a constant sense of urgency, a low-level panic that never really shuts off. People don't talk about this because it sounds ungrateful. How can I be stressed when the business is making money? But profit on paper doesn't always translate to stability in real life. Today, we're talking about that disconnect, why profitability doesn't automatically bring peace, and what the numbers might actually be asking you to look at.
This is where so much silent shame lives, because we've been taught that profit equals success, and success should feel good. So when it doesn't, people assume something is wrong with them. They minimize their stress, they tell themselves they should be happier, they keep pushing, hoping the feeling will catch up to the numbers. But panic is in real life doesn't mean the profit isn't real. It means the experience of business isn't sustainable yet. And ignoring that disconnect doesn't make it go away, it makes it louder.
From a financial standpoint, profit can be misleading without context. Profit tells you what's left after expenses, not when cash moves, not how predictable income is, and not how exposed you are to risk. Some common scenarios we see: profit driven by timing differences, not operational strength; one time wins masking ongoing cash strain; owners deferring pay to alleviate cash flow; or debt and obligations eating future flexibility. On a report, everything looks fine. In reality, there's no margin for error. And when there's no margin for error, your nervous system knows it, even if the numbers don't say it out loud.
This is where leadership becomes exhausting. You're not just managing tasks, you're managing uncertainty. When profits exist without predictability, it creates vigilance instead of confidence. People become hyper aware of every expense. Every decision feels like it could be the one that breaks everything. And because the numbers say you're fine, leaders don't feel allowed to talk about how heavy it feels. So the panic stays internal and unresolved.
How are you today, my friend?
I'm doing fantastic.
Good, good. I love this topic. I say that every single time, but
Yes, you do.
I do love this one because when we are growing and more profitable, we're seeing more at the bottom line or the top line. We have these small wins. It's super exciting, but so often I see I see conversations come to me, we've got more revenue coming in, but there's not necessarily more profit at the bottom. Or, we have more dollars coming into the bank, but you know, we won this $20,000 client, but now $20,000 is going out of the bank. So it doesn't feel as big of a win. And so I'm excited to talk about this topic and really shine light onto something that I think a lot of business owners and leaders experience, specifically in growth phases and scaling. And I think it's really important that people understand that profitability and being profitable is not the same as being stable. And so I really want to lean into the differences between profitability and stability, when one is more important than the other and when they should coexist. So um, I'd love to hear a little bit about what your thoughts are around that profitability and stability kind of topic.
Yes. So we touched a little bit in one of our prior episodes about the fact that there is a difference between profits on a profit and loss statement, a P&L, also called an income statement, and actually translating it to cash in the account or stable cash. And so you touched on one thing earlier in this conversation. That might skew things, and that is, landing one big job and then, oh great, it might be even profitable, and so you have, more cushions for more discretionary expenses that year or maybe that season or whatever. But it's a one-time win, and so you can't base your you have to be successful, you really have to continue having those. And we talked about last time how unclear it becomes, especially when you're moving to cash basis for your reporting to accrual basis. a lot of things kind of get lost in, it's no longer, with cash basis, you pretty much know that when you have received cash, you can call it revenue. When you write out a check to somebody, you can call it an expense. And you kind of understand what your position is at any given moment, because everything is tied to cash. You're like, cash is running out, I'm going to skip bills this week, and you have a little bit more control. But things become a lot more foggy when you are dealing with accrual basis and with the various components that go into it. Just because you have revenue in a certain period doesn't mean you're going to get cash for it in that period, and it doesn't mean that that there's essentially a timing difference in when you can realize that cash. Same thing goes with, you might have an expense on your P&L. It doesn't mean that cash left during that period, or it actually doesn't mean that cash left at all, depending on the type of expense. And I'll get into a little bit more of that meat here. First, let's to our listeners out there who are not as familiar with kind of the breakdown of financials, I want to break it down into kind of simple concepts. So first, let's talk about balance sheet transactions and income statement transactions. So you can have a strictly kind of balance sheet transaction that doesn't even tie to your profit and loss, but uses up cash. So for example, that one is if you're buying an asset, you're buying a building or machinery or a car, or whatever. The accounting, the accounting journal for it, how you would translate it on your books is does not touch your income statement at all. You're decreasing your cash and you are increasing an asset. So this transaction happens. You would never know about it if you're just looking on the P&L. And then an example of income statement transaction. In an income statement, you either increase your income or increase your expenses. And the offsetting side of that is something on the balance sheet, but it does not automatically mean that it is cash, or that the cash is immediate. So not all accounting transactions that impact profitability, that essentially build your income statement, turn into cash, not immediately, as I mentioned. So recognizing income on the P&L, this may increase your income, but it doesn't convert into cash flows immediately. So for example, you have net terms, you might get you've accrued your revenue, but it might be 30 to 45 or even more days of actually receiving the cash. Then let's talk about an example of an expense that you might see on your P&L, but it doesn't, it's not as straightforward. So let's talk about a deferred income. This is where some business owners can get in trouble with this, where essentially somebody has prepaid you for something. Let's say, you have, let's say I'm working on something for your business, right? And it's a project-based thing. And I say, it's going to cost $50K to work with me. And you're like, okay, you write me out a $50K check. But really, I can't call it as income for me. I haven't earned it yet. In fact, until I earn every single piece of that $50K, it really is a liability to me. There are instances where you might get me cash for, okay, Sassy, please, do this project for me. I've deposited the cash, but due to accrual accounting, I will be kind of chipping away, amortizing that revenue, between the periods that it takes me to work on this project. So even though I am, amortizing that revenue, the cash is already in my account. And so I have to be very strategic about not using it all at once, because I'm going to be accounting for it in future periods, which might look deceiving in future periods, on the, I might think like, well, okay, I earned this revenue. Why don't I have this cash in this period? Well, because in this instance, I received cash way before the project began. So that's kind of an example of, cash not aligning exactly with the timing of the revenue. And on the expenses side, it's also not an immediate cash implication per se, or doesn't automatically follow the timing of the income statement. So we talked about this last time with the concept of prepaids. And I think to our general audience, insurance policies are a great example of this. You're paying for a policy period that will last you a year. You had to front cash for it, even though you'll be expensing it throughout the year, but you already had to front cash for it. So again, just kind of illustrating that difference in the timing of when you're seeing the components of your P&L versus actually having cash in the account for it.
I love that you touched on this, and I know we did touch on this a little bit, like that cash versus accrual, but you had mentioned like there is a time and a place for cash basis. I don't disagree with that, but to an earlier episode where I mentioned like most accountants or CFOs prefer accrual, I think what you're digging into is a very logical reason why we prefer accrual. Because when you are working on cash basis, you do, right? Like I have a client right now that this is very pertinent to, that they operate on cash, they're taxed on cash. And it's also important to note that you may be taxed on cash basis, but you can still operate on accrual basis within your business. So they operate, they're taxed on cash basis. So they just thought that they had to operate on a cash basis within their business. But where it's really becoming a problem is they work on big contracts with clients and they see these big swings like, hey, we signed this $50,000 client in January, we got $50,000, and February didn't shape up the same. The problem is when you're doing cash, you saw that cash, you recognize that cash into the bank, whereas on an accrual basis you receive the cash and you can still record that deferred income, right? So you're going to say this is a $50,000 contract over the course of 12 months. We're only recognizing, I should have done 60,000, but like the math in me is having to work right now. But 50,000 over the course of 12 months. So if my math serves me correct, we're doing just under 5,000 each month. So we're recording that as income, and then we're putting the rest on the balance sheet as deferred income, like you said, a liability, which is signaling to the CFO or whoever is going to be the relevant party reading and understanding the financials on a monthly basis that, we've recognized as 5,000 of this 50,000, meaning if we don't fulfill our side of the contract or the client decides to void the contract, leave the contract, etc., we are still liable for $45,000 back to them. And so I think that this is really where my point in those earlier episodes about accrual being favored is you do recognize more of those accruals and you can level out those big swings versus saying we got 50,000, January is a great month. What the cash basis doesn't recognize is that you really only made 5,000 in January and you're going to receive the rest of it over the course of the next 11 months. And so I love that you touched on the cash versus accrual. Again, there is a time and a place, but this is a very relevant topic when it comes to profitability, why accountants would prefer accrual.
I want to bring this high level again. Kash, can you talk about how fear changes decision making under the surface?
Yeah, I think this kind of goes back, this kind of leads into where I just was talking about cash and accrual. When fear creeps in, it's due to the unknown, right? And so when I'm working with business leaders, business owners, they don't need to be experts in reading the profit and loss. They don't need to be experts in reading the balance sheet, but they do need to understand the numbers influenced. And so with my clients specifically, part of my part of my requirement in onboarding a CFO client, if you will, bookkeeping is a little different. But when I onboard a CFO client, part of my requirement is that they have a 30 to 60 minute, depending on the size of the company, depending on what needs to be talked about each month after the close, a 30 to 60-minute executive call. And in this executive call, I'm going through trends that I saw, red flags that I saw, maybe things that got coded to a suspense, or ask my accountant, if you will, to get them categorized accurately. Um, but when we don't have those, or when business owners don't understand that, my marketing went from 5,000 to 10,000 January to February, they're just going to keep throwing money at marketing, and then they're going to get resentful and angry when they realize how much is going to marketing and not understand the ROI or lack of ROI. Same with income. Like when they don't know the high level of what's going on, their decisions become very reactive and not proactive. And so you you again don't need to be an expert in the financials, but you need to understand the high levels, what changed, what's working, what's not. And some great KPIs that I really push on a lot of my business owners that I work with are, first, run rate. So run rate is this idea of, if you stopped receiving revenue today, no more pennies for however long, how long could your business run? Most business owners don't know what their run rate is, or they say like 1 week, right? Like, and
Mhm.
every run
Mhm.
rate is, your run rate is different depending on what industry you're in. When you look at high level, you should be able to cover your payroll for at least a month if you were to stop receiving income today. And we never think that revenue is going to stop. But when you think about the last 5 years and things that have happened globally, COVID, I don't want to get into the politics of it, but that was catastrophic in so many different industries, and it halted income. We never planned for it. We never expected this pandemic to happen, but there was this transition of companies that were working in an office now had to figure out how to work remote, and they were shut down for a week or two. You have to understand, can your business still operate? Can it still run if you stopped receiving income? For some of these businesses, they weren't ready to operate remotely overnight, meaning their APAR wasn't happening. So you're not getting paid if you were part of their AP.
Mhm.
So run rate is super important. The next thing that is super important at a high level is your burn rate. How quickly are you burning through the cash that's coming in? And is it going to things that are churning an ROI? Most times we look at ROI as an investment, right? If I put $5,000 into a piece of equipment, when am I going to get my 5,000 back? Or if you have an investor that's putting 5,000 into your business, when are they going to get their 5,000 back in dividends or distributions, or what have you? But but ROI can be, it can pertain to anything. It can pertain to your it can pertain to your income, right? Like there's some income that comes into my business that actually costs me more than it makes me. There's expenses that, yes, there's dollars going out, but marketing, I hit on marketing all the time because it's just kind of an easy an easy area to pick on. But marketing is a very easy area to throw dollars out at and then not know what's coming back. But essentially, when I spend dollars in marketing, it's to get something back, right? If I'm spending money going to a trade show, very expensive, doesn't matter what industry you're in. Trade shows are expensive. But if I'm spending $100,000 in marketing to go to a trade show, when am I going to get my $100,000 back? How many clients do I have to get to get that 100,000. So there is an ROI to everything we do. So burn rate is super important because you need to know what's going out, how fast it's going out, and at what pace is it going to come back into my business. The third thing that I really like is budgets. And these are really hard to put together if you don't know your numbers. It's really hard to follow if you're not doing those executive calls or going through high level numbers each month. But budgets hold people accountable, right? You take out the free for all spending um, or again, that accountability. When it comes to marketing, you can say you have a budget of $5,000, use it how you will. We want an ROI on that $5,000, but it prevents the marketing team from saying, well, we want to do this $3,000 advertising engagement. We want to go to this trade show, which is $5,000. We want to sponsor this golf event for another 2,000. Before you know it, you've blown through $10,000, but there's no accountability because no one told them they could only spend 5,000. So budgets allow you at the end of a period to say, this is what we said we were going to spend, and this is what we actually spent. Where were we under? Where were we over? Is that overage actually coming back to us? Could we have spent more in the under to get a better ROI? So budgets are so important. I also think it's very important to note that when it comes to budgets, they are ideal, right? No budget I've ever seen ties out. It's just an accountability measure. And the last thing that I think is really important to kind of highlight is monthly reoccurring revenue and annual reoccurring revenue, because what this tells you is, what can I count on next month? What's actually coming in guaranteed because it's contractual or there's an agreement in place, and what is just like they could leave tomorrow. It's super important to know what that monthly reoccurring revenue is, and on an annual basis, so that when you create the budget, you know at bare minimum this is what is coming in next month, or at bare minimum when we're looking at 2026, this is what we can expect to come in. Then you can start to build deeper KPIs in, well, this annual reoccurring revenue is 25% below what we did in 2025, and our goal is to be 10% above that. Here's the difference. I need this amount of revenue coming in, which extrapolates out to this many clients, this many services, etc. So you work backwards. But when you have those high level KPIs, you're then able to kind of work backwards.
Absolutely. You touched on a lot of great measurements there. I think wielding the right data and the right information is what can help prevent those emotional decisions from happening. When you see that business isn't doing so well and you just don't, you're not tracking these various rates, budgets, and all of this stuff, you are then left to make emotional decisions on the fly. And this is where it can lead to trouble. Like, for example, if we are, the goal is trying to be more profitable, right? So what does that mean? Like, what are the levers of profitability? Well, we know that there are two components in them, really three if you extrapolate one component, but it's revenues and expenses, right? And so if you the extrapolation is, the expenses, there's direct expenses of what it takes to bring that sale even in-house, and then the rest of the expenses, this is your overhead to run the business, right? And so that to bring profitability, the levers are either increasing your revenues or decreasing your costs, or you might hear increasing your gross profitability. Well, it's almost the same concept. You're increasing your gross profitability means you're decreasing your direct costs of what it takes to land the sale, and so then you have more to spread for overhead. But regardless, in an emotional and kind of uninformed position, when you think about increasing that profitability, you might go on a slashing expenses, run and start just slashing everything in sight. And if you don't have an idea of like what should you be cutting, like where do we need to trim the fat? Where is the fat? Um, I have a client that luckily understands these concepts very well, and one of my very first projects with them was cutting like a third of their staff, which was a very like emotional process, but we did it in a way where we needed to be careful. Like we knew that we couldn't sustain about a third um, of the staff with the margins that the business was running under, but it was a very very strategic operation of what exactly can we cut so we don't hinder ourselves. Like for example, if you're kind of looking on the surface and you're like, oh my goodness, my project managers, they're so expensive, like I need to cut two of them. And so you make a cut there, but in reality your issue was not with the overhead expense, it was with your in your margin, like actually in how the job is being performed. Your laborers are taking too long, or whatever, they're taking too long on the job, decreasing those margins. And so in this case you perhaps maybe needed to have more training. The PMs need to be more loud in this equation of, hey, talking to their staff of, this is your labor budget, don't exceed this time, and really work on getting that gross profitability up. Where an emotional decision of, oh, this guy costs me 90 grand, gotta cut him. Well, now you've worsened the situation because there isn't that accountability to the folks who are the laborers on the job, because there's nobody supervising that job anymore. So you have to be really careful about what data you're looking at when you make those decisions, to make sure that they are not emotional decisions.
I fully agree with you. I think this all comes back to, I think the overarching issue here is when you don't know high level KPIs, and they don't have to be the ones that we mentioned. I think that these are some of my favorite because they lead into conversations around what the relevant KPIs are for the business. But when you don't have something to measure against, you start to become reactive instead of proactive. And when you're making reactive decisions, it can be reactive around cutting costs, or it can be also reactive in, I've seen this too, where you're like, the business isn't doing well, if we just do this marketing engagement we'll get X amount, and you don't really look at the ROI in that. Like what's the acquisition cost on that client from this marketing engagement, or having the conversations around like, well, how many on average, how many leads are going to come from this marketing engagement, and really again working through that data. And so when you implement some sort of KPI measurable, every business is different in how they determine expenses that make sense, revenue that makes sense, cuts that make sense. The overarching thing is that when you're educated, these decisions become less emotional, less reactive, and more proactive in, we aren't going to have as much revenue next month as we had anticipated. Our payroll doesn't change. What are our options here? Do we do layoffs? Do we take the hit this month and really educate, like take it as a learning opportunity? But it sounds like in your situation, like so many situations, it was like, oh my gosh, we don't have cash, and we just need to cut. And you just become so reactive. And the problem with that is that these seasons are very secular in the fact that they ebb and flow, and you have a really good month, then you may have a lull, but then you come back up, and you don't become a good employer when, to your specific scenario, you hire, fire, you create this instability within your own business around employees. And in my situation, you create these instabilities with marketing. Like, we could really do this, but every time we spend 5,000, it hasn't turned great. And so I love that you touched on this, because I really think that it comes down to being educated enough to make educated decisions and informed decisions in your business. But I also think that this is a great segue into margins and safety. So would you talk us through the difference between margin and safety?
Yeah, to answer this question, I kind of want to give our audience a little bit of break concepts up a little bit. So, we talked in this episode about profitability. You know, what we see on the P&L that tells us our operations are heading in the right direction, and the whole concept of, well, do these operations translate to cash, or is cash held up? So I want to talk about some KPIs and some forms of measurement and planning for both to be profitable, but also to assess your cash health, if you will, knowing that there are these different nuances to the P&L, and that, you know, as we learned today, the P&L bottom line does not automatically translate to cash in the bank. So let's kind of first talk about the profitability aspect of it. So um, profitability, how do we approach it, and how do we know what to strive for? This is where I work with my clients on having them be very familiar with the break even formula and the break even concept. And so what does this mean? So the break even formula, it consists of the actual formula is fixed costs divided by contribution margin ratio. So let's break these components down. Your fixed costs are everything that you have to pay for to really keep your business afloat. So you know, this is your employees, this is your rent, your utilities, your insurance. I'm probably forgetting about some other ones, but this is also what we call overhead. Before you even make any, you know, connection sales or anything like that, you need these things in place to even have a business, right? And so these costs, they're fixed because they will be there whether you are making a sale today or not. You still have to pay for your rent, for utilities, you have to pay for the people who showed up. But and so the contribution margin, so the cost components in there are the costs relating to your revenue. They're either called COGS or variable costs. So COGS it's your direct labor, direct materials, you know, any equipment that you might need to use. Variable costs they're almost like COGS. They're almost direct, but they're kind of semi-indirect. They do move with revenues, however, unlike fixed costs. So an example is commissions. So, you know, your salesperson, okay, they might have their normal base salary, but if they make a certain they move either with revenues or gross profitability. So whatever you have set up as your contract with your salesperson, you know, if they bring in a certain revenue amount, you pay them a certain percentage or a certain fee. Or if they perform with a certain profitability, you know, you give kickbacks that way. Regardless, the contribution margin is essentially, it's your what is left over after you have paid for all the direct expenses in bringing this revenue. So it's what remains in the end. So the contribution margin tells you what's left over after paying all of the job related costs, but the break even tells you how much of that contribution margin you have to generate to pay for that overhead. So, and essentially when we're talking about break even, it means like, what do I need to bring in to essentially equal the amount of my just to cover those fixed costs. So this means no profit. Breaking even means zero profit. So you've just covered your base needs. To make this digestible for business owners, I like to ask, how much revenue must I generate with a specific gross profitability goal to break even or to cover all of my costs, including overhead? The formula to break even revenue is fixed costs divided by contribution margin ratio. So let's put this into an example. Let's say my fixed costs are 150K per month for all of my rent, salaries, everything like that. And my contribution margin, well, let's say in my business, all of the jobs that are being brought in, there's a goal of you have to bring in 35% gross profit margin. Every business is different. This is something that your accountant or CFO or along with your founders really have to come up with this to find out, like, what is the margin that we need to stay competitive, but also to be able to cover all the overhead costs. So let's say that the goal is 35%. We know that 150K is fixed cash, whether we have any revenues or not. Our goal is 35%. So how do we calculate the contribution margin? Essentially, it's that 150K divided by 35%. We're coming up with a little over 428K. So this means that we have to bring in 428K, I'll round it up to 430K in revenues per month just to cover that 150K overhead. So this is kind of how I plan with my clients, and this specific client who had to cut a third of their staff. We specifically looked at this. We narrowed it down to, okay, we cut all the costs that are reasonable to cut in overhead. Now this is our true overhead amount. Like, we can't survive if we cut anymore. Like, these costs have to stay in place. Okay, great. That's the first part of our equation. And so we kind of build on from there of, okay, in order to support this, we have to, with this goal of, let's say, 35% or 40% gross profit margin, now we're doing, now we can set goals for our salespeople. Okay, this is our goal. We have to bring in at least 428K this month. So we have 3 salespeople. Let's split it by 3, right? So now you have some sort of a foundation, some sort of a baseline to build your goals for. So you are at least breaking even. And I have to say, at break even, you're not paying off any liabilities on your balance sheet. You're not incurring, so it's not like a goal to strive for is to break even. That's not a goal. It's something, for you to understand of, okay, if we were to, in worst case scenario, in order to not lose any more money, right, not dip into your cash reserves, not lose any more, what do we need to do to at least stay in the same place? That's kind of what the break even helps to solve for. But we know that in real life, I mean, you really additionally need to carry some sort of capital reserves, right? If you have, if you're out there and you're starting jobs that require that, cash up front, and you're not in a position where you can collect deposits, from clients beforehand, you really have to have some cushion of operating cash so your workers can start their jobs and start bringing in that revenue. So I have a client who, I think we touched on this in some earlier episodes. They are pretty much on any given there's about a fifth of their cash reserves that are constantly being held up and that are um, uh, to start jobs, to maintain jobs out there. And so they're always, about they're earning this much, but they're always behind in, okay, only next month can we bill for this type of thing. So you really, really have to plan ahead, and, not just, it can't be your goal to just break even. You need to think um, about these other concepts. And in order to bring in sufficient contribution margin, you really have to price your products effectively. Meaning, like, as we discussed, that there is more. You have to cover this overhead, so you have to um, calculate a portion of your overhead in your pricing to make sure that you will be able to actually cover your bills. Um,
Yeah, I love that you talked about this. I have a story also to add into this.
mhm.
I don't have all of the calculations on contribution margin, but this is such a relevant topic to something that I dealt with earlier in my career. So back to my humble beginnings, sitting as I believe I was sitting as a controller at this point in time with a company, and they were in a massive growth period. They were growing. When I came in, the business was doing like 7 to 8 million top line. They really didn't know their margins by product. They didn't really know margins by customer, anything like that. So I started implementing that when I came in, and we kind of knew the industry standard margin for gross and net. But this became really relevant in sales and commissions, right? And when you look at most businesses, sorry, execs, sorry, anyone else, but when you look at most businesses, the highest paid employees are usually your sales team. It just that's facts, right? So if you want to make a lot of money, it's not necessarily the C-suite, it's usually sales. But sales is not an easy job. I would never be
I
be
could
a
never
good
do it.
salesperson. I'm not equipped to be a salesperson, but they make the big bucks because they're the lifeblood of the company. And if they're not doing their job, there is no company. But what was happening was there was this thought that and the one of the leaders at the big table was a salesperson. And so the mentality was we have to keep the salespeople happy. We have to keep, their compensation healthy. And they made a decent salary. It was not something that most salespeople would or could live on. Um, we followed any applicable laws. But when you look at salespeople, it was not enough to live the lifestyle that they wanted to live. They really made their money in the commission. The commission structure at the time was a percentage of um, revenue. And so basically what was happening was, again, for easy math, they would sell something for $10,000. They were getting a percentage of that $10,000. And so again, for easy math, we'll just say it was 10%. I don't remember what the exact percentage was. But what was happening was they would sell this for $10,000. They would get $1,000 right off the bat for commission, right? But when I started digging into this was already in place. So I kind of became the mean controller because my job was to decipher some of these numbers. But what I found was they're taking the 10% off of the top. And when we started digging in after COGS, we were actually not profitable, right? Like our revenue was really healthy and the salespeople were really happy. But when we looked at the gross profit, not industry standard, and we looked at net profit, and we were most months in the negative. And so I had to dig in because they didn't understand that you're giving the salespeople a portion of dollars coming in before accounting for any other thing. So we can continue to do this, but we have to understand and make sure that the percentage that we're giving them makes sense to um to the relevant SKUs. And in the industry that we were in, we had commodities and we had value adds. And so for those listening that may not deal with this, a commodity is a single item or a single component SKU, meaning, you know, if I'm drinking coffee, right? The commodity is just the coffee. If we're looking at value add, we're talking about now I'm ordering a latte or a mocha, right? There's now milk involved, there's sugar involved, etc. So what was happening was these salespeople, because salespeople are also very smart, they can be very lazy, but they work the system, right? They're smart in the fact that they work the system. They're going to put their most amount of time to where they're going to get the biggest ROI and the most efficient. And so what we found happening was our best profits were on value adds because they're sticky. You can't go get these value adds anywhere, right? But it was way easier to sell the commodities, right? Like I can go sell a coffee to anyone. They can add whatever they want to add to the coffee, but the margin on that is so slim because I can go to coffee shop A, coffee shop B, coffee shop C and get coffee. But I can't get this mocha from this one or this latte from this one. So what they were doing was they were selling commodities. We were heavy in commodities. Our goal was 60+% in value add and 40 or below in commodity. What I found in this exercise was we were selling about 80% commodity, meaning that's a race to the basement. So they could technically be selling it at a 10% margin and they're still getting, 10% off of it, which eats into the profit even more. And so these break even formulas, these contribution margins, this is where it becomes really applicable because when you start talking about comp plans, when you start talking about materials or industry standard gross profits, you have to account for what is going to go out before it even comes in. And in our case, we already were in a position where we were setting ourselves up for failure because, yeah, we sold $10,000, but we were already $12,000 into that product.
You have touched on so many gems there. I want to extrapolate a couple of items in there. So, excellent point. I mean, if you are, it doesn't mean that you should not be paying a commission off of revenues. But you just touched on kind of the full picture and needing to plan for and understanding all components involved. So, we either like there are different industries. So, from my world, kind of more of the construction and real estate type, you have one project manager who kind of lands the sale, but then they kind of oversee the project, right? And so in this scenario, I could see it making sense, like, well, you need to not just, okay, you've landed the sale, so now you don't care about how the job performs. So in this scenario, you probably want to structure the commissions to be based on the actual gross profitability. How did the job perform overall? But you can't always apply that. Like if you in a different industry, you might have a salesperson just generating sales and then somebody else who kind of sees that the product makes it, it delivers the good. Somebody else oversees the actual, project or product or service that's being delivered. And so then, you shouldn't be punishing the salesperson if the other person, isn't managing the job well. But in this scenario, and to my earlier point, is when you bid these jobs, you want to make sure that in your that you have banked for, that it's not just going to be your direct costs. There's a certain percentage that you should know for your overhead. You should already know this as a percentage of general revenue that you plug in on top, as far as costs that you have to cover. And then to your point, okay, commissions is another component of this. So we want to make sure that there is enough room for commissions as well. That doesn't take away from that gross profitability. So if you're building that within your structure, then you know that your salesperson can still get a percentage off of the revenue, but you still made your gross profitability of, let's say 35% because you baked it in there. And so that means that you really do have that 35% to cover your other overhead. So excellent topics there.
And I think you can even take this another step further. And, another pain point that we had in this exact scenario is they were receiving the commission when the sale was made, right? So it was 30 days later. So if they
Mhm.
sold product in January, their commissions were ran February 15th. So they were paid February 15th for anything that happened in January, but they were not responsible for the full cycle, meaning they've already sold the product. The product's already left the building, but now the responsibility was on the accounting team to collect the dollars because they've already
Mhm.
made their commission.
Mhm.
Sales and marketing people are probably going to hate me listening to this. I don't care, but I love you guys because we need you guys in all businesses. You guys are easy to harp on, but they didn't care, right? They made their commission, they're on to the next sale, they're trying to bring more in, which is what they're supposed to be doing. But there's a cost to cash being out there. We've talked about that on previous episodes. So they've made their money. We probably haven't seen the actual revenue come in dollar wise. And if it doesn't come in on time, they don't care. Or if it didn't come in at all. And so we also had to implement a clawback. And you can get this. I'll pay you for January. You sold the business, it's left. You now have to collect it,
Mhm.
right?
I've seen
And
that
if
too.
it's not collected within 60 days on that next commission check, then I'm going to claw back that and
Mhm.
reduce your commission. And so again, this is where you incentivize. You have these KPIs, you incentivize your employees well, but you have to incentivize them not just with that first attack or first win, but the full picture cycle, right? Because if we
Absolutely.
sell $10,000, we never collect it, that's also a problem too. So, um,
Absolutely.
huge fan
Absolutely.
of KPIs.
Yeah, and on that, let's transition into the last piece of the KPIs. We touched on the profitability ones, but let's talk about the balance sheet ones, and specifically ones pertaining to cash, because in this episode, we're really honing in on the differences between, profits that you might see on a P&L and actual cash that you have in your bank account. So there are a couple of very general KPIs that business owners and banks like to look at to really assess the health of an organization. We talked about all of these kind of gray areas on the P&L. Okay, that's great. We can still understand how a business is doing on a high level by plugging in a couple of ratios. So one of these ratios to check your liquidity is called quick ratio. Essentially, this measures your ability to pay short-term obligations with your short-term assets. So if revenue stopped today, could you pay your bills, your cash and your ARs, and divide them by your current liabilities? So if you get a 1 or above, that's a good thing. And if it's less than 1, then we're getting into a risky situation where you do not have enough cash flow to support those current bills.
Yeah, and I would add to that. This is actually one of my favorite ratios because you're looking at what do I have without having to liquidate. And so again, I know we've touched on this before, but I want to touch on it again. Short term means that you either have it liquidated or you can liquidate it within a year is kind of how we look at short term. And on the liability side, it's something that is going to be paid within the year or kind of off of the balance sheet within a year. And long term, again, is anything over. So if we're looking at, fixed assets in the manufacturing world, would be a big piece of equipment. You're not going to be able to sell that quickly. That would be a long-term fixed asset that we would likely take more than a year to liquidate into cash. And going a little deeper into your 1.0, 1.0 is kind of like the ideal sweet spot. Again, every industry is a little different. You may be looking to be zero point 0.8 or, 1.2, but 1.0 is kind of the sweet spot, generally good, meaning the company has enough quick assets to cover the current liabilities. If you're below, to your point again, we're indicating the company cannot pay its short-term debts with its most liquid assets. But here's the other caveat that a lot of people and business owners don't talk about is, we focus on the low, right? You don't want to be too low because now we're indicating we can't cover these things. But on the flip side, you also don't want to be too high. When I have business owners that are, 1.5, 2.0, I'm starting to see red flags as well, because it suggests that you're holding too much cash, or you're not investing in growth or investing in, assets that could produce growth. And so I think it's really important to know that when we're looking at this ratio specifically, higher is not better. There's a sweet spot, and below that is a little bit of a red flag, and way above that is a red flag.
Excellent.
Another one that is super important is DSCR, which is debt service coverage ratio. This talks about the company's ability, or a property's ability to pay its debt obligation with its operating income. This ratio is calculated by net operating income divided by annual debt service. And some of the things that are important in this one, and I'm going to let you dig into this one a little bit more, but it again is a formula that is going to produce something in the 0 to typically like 2 range. And we're looking for, again, like that 1-ish range, right? So if you're less than 1, it's meaning that your income exceeds debt payments. And if you're at a 1, income exactly equals the debt payments. And if you're more than 1, it means your income is less than the debt payments. So it indicates like this potential default risk, which is very important in the lending world, which I know is very relevant to the construction world, because there's so much lending that goes on, and you're dealing with banking relationships, and your relationships only go so far. And so DSCR is something I know that you deal with on a regular basis. So I think that you can speak to this one a little bit more now that I've laid a little bit of the foundation for the listeners.
Yeah, well, I think you've covered the main aspects of it, like what it solves for and what figures tell us we're heading in the right direction. Essentially, DSCR shows us what the break-even formula alone won't tell you. If we kind of remember, if we rewind back to our conversation about the break-even formula and just break-even concept, we are talking just about, profits, profitability, operations, right? And what we have talked about and touched on in several episodes is your profit and loss, your income statement alone will not tell you about what cash position you're in. So I have a client who has very, very thin margins, and yes, they are profitable at the end of the year, but barely. And the bank they don't just look at the profitability, they look at the DSCR is a big ratio and a health indicator that they specifically look at, because, okay, so you made, 5%, let's say at the end of the year, which translates into, I don't know, like let's say $1 million, right? But you have a huge debts, and that $1 million is not able to cover them, or barely covers them. And
Mhm.
so again, to kind of take away the fogginess of the different layers of our profit statements, this ratio specifically shows us if we are able to um, sustain with that profitability, if we're able to cover our obligations.
So I think it's super important to note that I know you have banking relationships, and banking relationships are super important in the seat that I sit in too. And there's some times where those relationships will trump, right? They know you're going to come through. They know, like, maybe you don't have a 1.25 DSCR ratio, but they know you, and the relationship trumps that. But the grander thing here is that banks very rarely take risks, if at all, right? Like, they're kind of the house in a gambling situation, and the house always wins, right? So this becomes very important in, when you're opening up credit cards, when you're opening up loans on the business, liens on the business, etc., to cover things like payroll, or uh, whatever you consider growth. You have to consider these in the grander scheme. If you want to purchase a big piece of equipment, but you're carrying all of these credit card debts or short-term loan debts, that's going to affect your ability to take out a loan on something that's really going to push the business forward or generate revenue for a real ROI. So I think it's important to note that while these may not be relevant today, when you're looking at that grand scheme of things, these are some really relevant ratios. Um,
Absolutely. And the client that I am thinking of, where this is a repeated exercise, like, so for example, I have a client who has a line of credit with the bank, right?
mhm,
And the bank is very familiar with their business model, their kind of ebbs and flows, and the particulars of the business. But to your point, bankers are not in the business to take risks, right? And so we have this client has a pact with the bank of, you need to make sure that you're hitting this. And they've worked with the client, because to your point, yes, one kind of gives us a health indicator, and your loan covenants might dictate one or better, but your actual banker, if they're a good banker, if you have a good
mhm,
relationship with one, they'll work with your individual business. And so they might say, hey, you were at zero point 0.7 last year. If you can get it up to 0.9, within 9 months or whatever, then we should have no issues in renewing this line of credit.
mhm.
But if we're seeing that you consistently are, less than one and decreasing, then it's too much of a risk for us. So you're absolutely right there. And this is a very common ratio that banks hold their clients accountable to.
Yeah, I completely agree. So I think we should probably start to land the plane.
I couldn't agree more.
So here's the reframe we want people to hold on to. Profit isn't the finish line, it's a data point. What you're actually seeking is stability, predictability, margin, and enough slack to make decisions without fear. When profit creates panic, it usually is because the business lacks cash visibility, operational consistency, or a buffer for uncertainty. Those aren't failures, they're next steps.
And from a human perspective, this is important. Feeling anxious in a profitable business does not make you an ungrateful or broken person. It means your nervous system is responding to risk your brain hasn't named yet. Safety isn't created by numbers alone, it's created by understanding, margin, and trust in the business and in yourself. And that kind of safety is built intentionally, not accidentally.
So, if you're profitable but still feel on edge, here's what we want you to remember. Your numbers aren't lying, but they may not be telling the whole story. Profit is information. Panic is information too. Going past the balance sheet means listening to both without judgment and using them to guide better decisions, not harsher self talk.
And it means giving yourself permission to want more than fine, more clarity, more breathing room, and more sustainability. You don't have to wait for burnout to justify change. If something has resonated, hold it with curiosity, not criticism. And when you're ready, come back and keep going past the balance sheet with us. If this episode resonated, we'd love your support. Follow or subscribe to Past the Balance Sheet wherever you listen to your podcast and don't miss what's next. And if this conversation helped you put language to something you have been carrying, take a moment to leave a review. It helps more business owners find real, honest dialogue about money and leadership.
The more we normalize these conversations, the less alone leaders feel. Thanks for listening, and we'll see you next time on Pass the Balance Sheet.